Whether you read the financial press or watch videos on YouTube or TikTok, you've heard about investment portfolio. Everybody is recommended their best and why theirs is the best possible option. Actually, there are not that many types, but there are many variations. We're gonna go through the basics of investment portfolio, and I'm gonna tell you what are the different types, why you should look at before investing, and how you should approach it. Sounds good? Let's get started. Hello everyone. I'm Morrow from Economia, your destination for financial independence, tips to invest and spend wisely. The 60-40 portfolio. Everybody has heard about it. 60% stock, 40% bonds. Very easy. And it's been around for so long. Actually, this gentleman, Henry Markowitz, Nobel Prize laureate, invented it in 1952. So it's been around for quite a long time. It offers you both stocks and bonds and kind of a best of both worlds. In the past 10 years, with the rise of the economy and the stock market, a lot of people have been negative toward this 60-40 approach. But actually, if you look at the figure, like you can see on screen, it's had a very, very good run. If we go into a bit more details, like you can see here, whether you look at 1 year, 3 years, 5 years or 30 years, it's winning every time between 6 and 9% annualized return. This is very good and very easy to approach. Actually, the 60-40 is not something that's set in stone. Depending on your age, you can vary the proportion between the stocks and the bonds. The principle or the rule of thumb is quite easy. You take 100, you subtract your age, and that's going to give you how much you should invest in the stock compared to bond. For example, if you're 25-year-old, you take 100 minus 25 gives you 75, and you should put 75% in stocks and the rest in bonds. And this varies with age. When you're at 40, 100 minus 40 makes 60, and then you get 60-40 portfolio. Pretty easy, right? From there, we're gonna go to a variation of it, and we're gonna go just after that, be patient, something that's really, really different. Let's continue. Now there's the three-fund portfolio. This is a very simple approach that's actually a variation on the 60-40. Rather than just saying stocks and bonds, we're going to try to see how you can diversify and approach it very simply without any stock picking, just based on index funds. How it works is simple. First you take, for the stock side, you take a broad stock market index fund in your own market, let's say US. And if you're not in the US, you take your own market. That would cover everything in your market on the stock. Then you're going to take a broad international stock index fund. When I say international, it's out of your home market. If you're in the US, that's going to be everything but the US market. If you're in Japan like me, it's going to be Japan for the main, and the other one is going to be everything but Japan. And that would be your stock portfolio. Now for the bond, you're going to take a total market bond fund, index fund, covering everything. So you get stocks, you get bonds, and when you look at stocks, you have geo-diversification, so there is no overlap. It gives you exposure to your own market and to other markets, trying to balance out the risks as well as the opportunities. It's a very simple approach. What I really like about it is it's based on index. You're not doing any stock picking. It's so difficult, and we've known and discussed the likes of Warren Buffett or other great investors are telling us that for most investors what's important is a broad index fund and not stock picking. You can do index funds, as you can see, you have them everywhere, but you can also use ETFs instead of funds. Those would give you more liquidity and the possibility of even lower, possibly lower fees. But also the other thing is the ETFs are traded as stocks. So if you already have a stock brokerage account, a 401k or the like, you can directly do it in there without going and opening an account into one of those big fund companies. Otherwise you would have two accounts. It's really a choice. It really depends on what you like. But this is the approach for the three-fund portfolio. Now there is a small evolution of this three-fund portfolio, which is the two-fund portfolio, which basically just gives you one stock portfolio and one bond portfolio. super simple. If you want to learn more about that, I'm going to put a link down below to an example by YouTuber Morrow, who is using a total US broad index fund, an international index fund, and a total bond market fund. And he gives a lot of examples of what's available in the US and how do you balance it between bonds and stock. We just saw before this table that shows you by age how you should weight each of them, and that would be a good approach as well there. So this is our 3-fund portfolio or 2-fund portfolio. I hope this is interesting. If that's been interesting until now, and before we go to the very special portfolio that's a bit more original and unique, do not hesitate to give a like to this video. Thank you, appreciate it. Now let's go to the portfolio that's a tiny bit different. This portfolio is called the Ultimate Portfolio, or another name is the Awesome Portfolio. The terms, both of them actually, have been coined by someone called Jared Dillion that you can see here on screen. He used to be a Lehman Brothers. They were quite interesting person to follow. Now he's a finance writer, he's a podcaster, he's also an investor. He has kind of a quirky approach, very interesting, but he's also a contrarian, and that's why this portfolio is really interesting. First, let's start with the origin, what he called the Ultimate Portfolio. This is a very simple portfolio. It's a portfolio that takes 20, 20, 20, 20, 20, 20% 5 times to make 100%. So how is this divided? It is 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. Yes, gold and cash. Cash is always good, right? You can need cash, you can put it aside as a buffer or to jump on an opportunity. Gold, it's a bit different. We don't always see that. People like buying gold and holding gold or investing in gold. Not everybody does. And real estate, always interesting because it provides you with some passive income. Now let's go to what he calls the Awesome Portfolio. This is a very different weight and asset allocation. It's 35, 55, 3, 3, and 4. 35 stocks, 55% bonds, yes, 3% broad commodities, I was about to say communities, broad commodities, 3% gold, and 4% REITs. Quite interesting, isn't it? Of course, the stock is going to give you growth. The bonds is going to give you really stability and some income. Commodities will react depending on the economic cycle, so they give you a good approach. The gold, again, another commodity that works a bit on its own. And the REITs is the real estate. But there, you're on the stock market, it's more liquid, and you get dividend on a monthly or quarterly basis, sometimes every 6 months, depending on the type of REITs. Quite interesting. The goal here is to limit the effects on a drawdown in a specific asset class to give you more stability, and when there's chaos in the market like we are living today, this gives you a bit more of stability and foreseeable future, right? Now, what's really interesting is this approach to our commodities, as I say. If you had bought commodities at the beginning of the year, they went through the roof. Whether it was energy or food, that went really good. Now, gold is interesting as well, as I mentioned, but if you do not like gold, there's another approach. You can go with cryptocurrencies. Yes, cryptocurrencies could replace gold. It's only 3%, right? So even if there's a risk, you're limited, your exposure. But also, there was a lot of work done in the market by a lot of firms showing that if you had in the last 5 years added cryptocurrencies to your portfolio, your return would have skyrocketed. Of course, you may not like cryptocurrencies and want to stay away from it and don't like gold either. Well, you can replace by other precious metal or rare metal. For example, we are seeing finally the development of electric vehicles. So now we need more batteries. Those batteries require a lot of rare elements, rare metal, precious metal. You could look at that rather than gold, rather than cryptocurrencies. And you don't want just to buy, if you will, or have an asset that buys and represents the actual metal. This could be the mining company. This could be the transformation company in this sector. That's a very, very interesting approach and completely different from the other types we've seen before. And it gives also quite good returns. armed with all this information, what should you do? First and foremost, remember, I am not a financial advisor. I'm just a guy on YouTube, and what I'm talking about is just my opinion, and this is just for entertainment purpose. Before doing any investment, you should do your own research and decide on your own without taking too much risk. And before investing, do not forget some important points. You have to make sure that your emergency fund is well funded. Remember, 6 to 9 months of living expenses. Making sure you don't have high interest debt, like credit card debt. You have to make sure that in case you have a retirement plan provided by your employer with a one-on-one matching, this is maxed out. As important. Actually, inside those kind of accounts, which are called 401k or iDeCo, depending where you live, you could apply some of the portfolio strategies we just discussed. Have you funded your health fund? Is it financed, HSA otherwise? Your child education, is it funded? Do you have life insurance in case something happens to you? And your family, your loved ones are depending on you. Are they covered? All of those things have to be taken into account before you start investing. And if you have money extra, of course, you should start investing if it's not in the 401k that I mentioned before or equivalent. If you do, think about an IRA or Roth IRA, if you're in the US, ISA if you're in the UK, NISA if you're in Japan, or equivalent in any other market, so that you're not getting taxed too much. And if those don't work, then go with a stock brokerage account. Do not put all your money in the stock market either. We don't want to put all our eggs in the same basket. You can diversify besides those portfolio. Rental real estate is interesting. Life insurance can be interesting as well. And all of this means absolutely nothing if you're not controlling your spending with a very good budget and putting money on the side, of course. Whatever you do, start early. Do your own research, and remember, all I've talked about today is just my own opinion. Make up your own. That's it for today. If you like this video or learned something, give it a like. Do not hesitate to subscribe for more content to come. If you have any ideas or any comments, do not hesitate to leave them below. Thank you for watching, and until next time, goodbye.